Hey, hello and welcome everybody. I'm Vern Cushionberry and I'm back with another market update for the first quarter of 2021. And let me bottom line it for you. I got my cheat sheet right here. Times are good. Markets were up in the first quarter. The vaccine is working. The economy is rebounding. Congress approved a $1.9 billion stimulus package in the first quarter. That put a lot of wind in the sails of the market. And we have a $3 billion infrastructure plan in the pipeline. All that bodes very well for the markets, but as I will show you here in a minute, valuations are still high and expectations for an earnings rebound are very high going into 2021 and beyond. There's no existing plan to pay for the stimulus. That will likely result in a new tax plan later this year. That has led to a rise in inflation expectations and a corresponding rise in interest rates. The secondary effects of that have not yet played out in the economy. Those are a very challenging thing to predict and will lead to unintended consequences, as they always do. That represents a source of unknown risk for the markets as we move into the next 3 quarters of 2021. So I always like to give our listeners the bottom line up front so that you can tune in, get the short version, and then tune out and get back to your busy days. But for those of you that like some charts and graphs and just enjoy seeing what we've been up to, I have a deeper dive for you. So I always start with the markets and where we've been. And as you can see, the last year from the low of the COVID pandemic, we're up 78%. This is the S&P 500, so a little bias towards domestic stocks there. But international markets have performed well, and I want to talk about that in here in just a minute, because there's an opportunity to diversify portfolios internationally. I also want to talk about the yield on the 10-year treasury. You can see that last year we were at about 1.6, and this year, or actually that was February of this year. If I go back to last year, we were at about, well, yeah, 219, 2020. That would be about 1.6. We're at about 1.7 today. So that has big implications for the economy. Remember, price is what you pay, valuation is what you get, which is always why I share this slide. The current price to earnings ratio, if we look at the S&P 500, sits at about 21.88, which is historically high. You can see that that fluctuates between 13-ish on the low end and 20-ish on the high end, and we haven't been up around these levels since just after the turn of the century. So that would argue that the expectations again are high. They're baked into market prices, and we need for those stimulus efforts to have an effect, and we need for the economy to rebound, and we need for the vaccines to produce some level of herd immunity to get us back to normal if we're going to expect continued gains from here. And I think that's just exactly what Wall Street and most of the pundits I read are expecting for 2021. Okay, let me move on to slide number, I wanted to share a little bit on slide number 8 here. I've been getting questions from our investors about the difference between growth and value. Now, that's a little bit of a nuanced conversation. What's a growth stock? What's a value stock? At its simplest, we can identify a growth stock and a value stock using that same price to earnings ratio that I shared with you a moment ago. The more earnings per dollar of stock price, the cheaper a stock is. And the more expensive, the more the valuation of that stock is dependent upon future growth. And we look at the disparity between what we call a growth stock and a value stock with this chart here. And you can see that as we look at the dispersion or disparity between the valuations of those two ratios, 0 would be some level of historical mean or historical norm, and typically value stocks get a little bit cheaper underneath the line, and growth stocks get a little bit cheaper or relatively more attractive, you might say, above the line. Growth stocks have been performing extremely well since the Great Recession. And that's largely on account of all of the stimulus we've put into the economy. Interest rates are low. That incentivizes investors to put money to work. They want to incentivize investors to put money to work in the fastest growing areas of our economy. And that has led to growth stocks doing a little bit better than value stocks. Well, that trend persisted until just this last quarter when we saw a little bit of a reversal. And I hear a lot of pundits arguing that value stocks are about to have their day. And certainly the last quarter would indicate that. Let me put a little bit more detail on that with this next slide, number 12. These are the effects of what I just showed you on that last chart. As growth stocks outperform, you see a rise in their price to earnings ratios. So I want to look at their performance. If I look at a 10-year annualized performance, in each of these boxes, you can see that we have value on the left, growth on the right, and then some measure of a blended portfolio in the middle. Along the vertical axis, we have large stocks on the top, mid stocks, and small cap stocks on the bottom. This looks very much like a style box lineup that you would see in a typical 401k plan. Over the last 10 years, you can see that small value has yielded about 10% per year, whereas small growth has yielded about 13% per year. That's a significant difference. And if you look over at the price to earnings ratio, that difference, that what seems like a small 3% per year difference for growth stocks, has manifested in an average price to earnings ratio of, now let's look at growth. Let's look at small cap stocks. Here we have the average price to earnings ratio for a small cap growth stock is 85.6. That's very, very high. That compares to a long run average of 35.2. So the average small cap growth stock, which has benefited, as I just showed you, from aggressive stimulus measures over the last 10 years, has now pushed the price of that stock over 2 times what you would think of as the typical average. So very expensive, and gives us as investors an opportunity to revisit where the future opportunity might be as we lay it out in a style box approach like that. Okay, moving on to slide number 18. I wanted to quickly share a little bit about interest rates. I mentioned that interest rates had been on the rise. When we spend this much money, when we have another $2 billion stimulus package and perhaps as much of a $3 billion infrastructure, that gets a lot of investors thinking about, well, where's that money going to come from? Which sparks inflation concerns. And inflation concerns, in turn, spark rises in interest rates. So we have this chart, which is a little bit confusing, but I'm going to try to break it down here for you. As interest rates rise, we begin to grow concerned that that might have a deleterious effect on income statements and balance sheets of corporate America. They're going to pay more in interest. So if they have a little bit of debt on their books, that's going to drag down earnings, and lower earnings lead to lower stock prices. And when does that begin to have an effect that we can measure on our economy? Well, we took a look at the 10-year interest rate down here on the horizontal axis, and we charted that against rolling 2-year correlations. And when the correlation gets above 0, that's meaningful. And what we saw was that typically we don't see interest rates begin to affect the stock market in a meaningful way until we get up around 4.5%. And then we ask ourselves, but wait a minute, 4.5% seems like a long ways away. We're at 1.7 today. So let's look at that through a different lens and only take the data points since 2009. Well, when we do that, we find that the correlations start to, again, become meaningful around 3.6%. With interest rates down here around 1.7 today, that would give us a long runway before we see those interest rates become a significant drag on the stock markets, given a historical context there. So history never repeats itself, but it rhymes, as they say. So we look at that data and try to use it to inform our decision making going forward. Okay, 21, I wanted to pause here and just check in on COVID. COVID's one of the big factors driving the economy forward this year, as it should. We've seen both fatalities and confirmed cases come down significantly. And what we're really looking for to get back to full employment, to get our economy back to speed, is this, what we call this zone for herd immunity. You know, the threshold is right here at about 60%. And we're tallying our population that has been vaccinated, the population that has been infected, and maybe both there. So as these numbers rise, these different constituencies have some measure of immunity, that's the wrong word, some measure of resistance, let's say, to the COVID infection. And we would like to see for that next bar, hopefully around May, get up above that 60% line item or line, which really gives us some confidence that we're about to get our economy back to full capacity. Okay, I want to move down here to 26. I've mentioned a couple of times now that interest rates are rising out of a fear that we'll see inflation, and inflation fears are sparked by total spending, and where that total spending is not yet paid for. As you can see here, here's our budget, our government budget for 2021. Total budget is $6.9 trillion worth of spending, and we have about half of that paid for with anticipated revenues, anticipated receipts. So we're going to have to borrow $3.4 trillion to plug that budget. That's not sustainable. Taxes are going to have to go up. Spending is going to have to come down. We look at this chart in the bottom right to give us some idea of where that's likely to go in the future. You can see that our total debt as a percentage of GDP has been rising since the early 80s. We're fortunate in that we have a balance sheet that's relatively better off than some of our global trading partners, but clearly we're on an unsustainable trajectory, and I share the fears of a lot of investors that I hold in high esteem when they shine a spotlight on this number and say something's got to give. The problem is picking the timing of that. You know, this is a scenario that could easily unfold over a decade or more, as demographics will play a key factor in determining how all this plays out. So that is not necessarily the time frame that's consistent with your retirement plan or your investing goals, which is why these little talks I give always end with the same advice, which is make sure you sit down with your financial planner and do some scenario analysis around your specific goals. Okay, a couple more slides here. I wanted to just pause on 37 and share a little bit of information about inflation expectations. You can see that inflation expectations have been rising pretty steadily since the beginning of 2019, and we are now expecting inflation of about 2.2% over the next 5-year period, which is not above historical averages really, but it is a big increase relative to what we have experienced in the recent past. So we're mindful of that, definitely mindful of how it has an effect on interest rates. Okay, 2 more slides. I want to come down here and hit 55. Bear with me. There we go. I mentioned a moment ago that we were looking at international. The US markets have done extremely well, up 78%, as I mentioned. International markets are up too, just not quite as much. So we have this chart which shows how there's some measure of cyclicality, you could say, to international returns. And that's kind of borne out in the data here as we look at the relative performance of the United States versus the EAFE. You hear people refer to this as the EFE or EFA. It stands for Europe, Asia, and the Far East. So just think of the purple here as international markets. The domestic markets have outperformed for the last 13 years, which is terrific. Most of our clients are in the United States, and they benefit from US company's doing well, they're denominated in dollars, which is how you're going to pay for your retirements and most goals. Notwithstanding, global diversification does have a benefit for most investors, and you can see here that that may represent an opportunity going forward to globally diversify. So we have been having those conversations with some of our clients as appropriate. And you can see here, we break that down a little bit further for you by measuring the relative attractiveness, again, using a price to earnings yield. And we look at that relative US versus international. And you can see here that international stocks are, well, they're more than one standard deviation than cheaper than what you would think of as the mean. So keep that in mind the next time you sit down with your planner. And let me X out of here and share with you. I'm going to segue now into, I touched on this last quarter. How much does it cost to retire? We track that with an index that we call the S&P Stride, and I'll blow this up a little bit here. This just happened to be very timely. Last quarter, I was looking at the fluctuation. This fluctuates with interest rates. As interest rates go up, it takes a smaller portfolio to yield the same income. If interest rates move from 1% to 2%, then you can have a portfolio that's half the size, generating the same earnings power that you'll need to live on in retirement. That's a good thing. And we track that with an income called the Stride. Well, Stride just published their latest quarterly report on what they call the cost of retirement income. And you can see down here what happened to the cost of retirement income when interest rates rose during the first quarter. If we look at somebody retiring in 2035, the cost of $1 worth of inflation-adjusted income for a 20-year period during retirement went from $28 to $24 over the course of the last year. So that's a significant drop. It's getting cheaper to retire. The challenge is that when we invest retirement plan dollars, we can invest in this index. And that index just went from 28 to 24. So it feels like you're losing money if you measure that in terms of dollars. When you look at the bottom of your account statement every month when it comes in the mail, you had $28 last year. This year you have $24. The good news is that $24 buys the same inflation protected income stream in retirement as the $28 did last year. So when you're applying a goals-based investing approach to funding your retirement, this is how a lot of professionals do it. It's called liability-driven investing, and it allows you to ignore a lot of the fluctuations that are typically embedded in your account balance with full confidence that what you're going to get on the back end is an inflation-adjusted income stream that, well, you've come to know and understand funds your standard of living. So this strategy, included with others like the international and a diversified portfolio of stocks and bonds, powers most of the portfolios that we build for our clients, and then we customize those as appropriate for one-on-ones with our wealth planners. Okay, lastly, lest I get a little bit long in the tooth here, I wanted to also share one of what we call our fundamental pieces. This is also published by S&P, and I think about this report called the SPIVA report as one of the most convicting reports in our entire industry, because on a quarterly basis, Standard & Poor's measures how well professional mutual fund portfolio managers are doing at earning their fee. And the only reason that you would pay a professional manager to manage your money is if they can earn a fee over the index or the benchmark. Otherwise, you would just invest in the benchmark. And I say this data is some of the most condemning in our industry, because you're going to see here that most professionals who try to do this fail over time. That fee differential compounds, and the nature of compounding makes it harder and harder and harder to outperform those indexes over time. And I'll just cut to the chase here and go to the meat of the data and dissect it for you. But I think you probably know what that story is going to tell because I've shared this data before. And here we go. Let's look at this report. I'll blow it up a little bit here. There we go. Okay. Now let's look at what this is telling us. This is the percentage of US equity funds underperforming their benchmarks. So you can think of this as the failure rate. The higher the number, the worse off our industry is doing at creating value for their investors. So you can see if we look at all domestic funds, over the last year, 57% of them failed. Over the last 3 years, 67% failed. 5 years, 72, 10 years, 83, 20 years, 86% of all domestic funds failed to beat their benchmark. If that's not an advertisement for the benchmark or for the index fund, I don't know what is. And that's where we're seeing our industry move over time. We've seen a marked preference for index funds with a diversified approach to global investing paired with financial planning that can add real value and help our investors get the goal with a much higher likelihood over time. But just scan that column real quick and you'll see 86, 94, 88. There's a 76. I think that's the lowest number on the page, 75. So failure rates of 75% or more in every asset class. Again, one of the more condemning pieces of data that you'll find in our industry, all of which is arguing for a good financial plan. So as I say, these quarterly market reports always end with the same advice. There's a lot of moving pieces whenever we dissect the market. Make sure you make time to sit down with your individual financial planner to make sure your financial plan is stress tested and that we've done a scenario analysis for any of the competing goals that might be affecting that plan. So once again, thanks for your time, and I'll see you next quarter with another market update.